traders, Todd Gordon of TradeAnalysis.com. How are you? Happy holidays. This is a gold video update in collaboration with Elliott Wave International. Pretty interesting macro movements happening after the Fed yesterday. A big stock market sell-off, and as a result, gold, which I'm short, I'll show you the position, I'll show you the Elliott Wave count, is moving lower, so I'll give you an update there. It's been a busy morning. I was up at 4 and then on air at 5 a.m. on CNBC talking about the Fed reaction here. So I was on with Frank Holland discussing, the macro movement and stuff like that. So I'll kind of bring to light in a more technical sense, I think, what's happening and potentially where gold may be headed. But, first I'd like to talk about the macro relationships a little bit, intermarket relationship. I like to use intermarket, which is like the four main asset classes: equities, fixed income, commodities, currencies. And they at different times, they have different and varying degrees of correlation, which I think help to reduce some of the embedded, inevitable ambiguity of applying the Elliott Wave labels, which I think is fine. There's sometimes correlations are in place and they help, and sometimes they break apart. And your job is to identify when the correlations are working and when they're able to be of assistance, helping you guiding you through the markets. And then when it breaks apart, recognize it, move on, and see if there's a new relationship. So one that I'm seeing that's been in play for a while is the stock market and the gold market. So if we look back, going back to the lows all the way in 22, the S&P is in red and gold is in black. And a lot of it has to do with the level of interest rates, real rates. There's quite a bit of theory behind it, but I think it's hard to argue that stocks and gold are showing some degree of correlation. And as you zoom in a little bit, you can see some periods where, they're very tight, and sometimes they're, kind of wandering inverse of one another. This is certainly not an exact science. But what I'm noticing is the stock market makes a new high here. Gold market made a lower high, and in line with their longer term, somewhat loose correlation, I'm wondering if gold is acting as a leading indicator to the stock market going into a deeper correction that we'll cover in another video. So if we look at the gold market on as labeled with Elliott Waves, this is what I'm looking at longer term. I'm thinking that from the 22 lows, we're doing minor 1, ABC down in minor 2, up in minor 3. We went to a nice 1.618, which is very textbook, Fibonacci projection of 3 versus 1. And again, that's based on the semi-log percent change. So, if you take the percent distance traveled in 1, which was 28.86%, multiplied by 1.618, that's going to give you the high here, which is 27.48 in wave 3. And then, then I think we're moving back in wave 4. So the green color-coded Fibonacci levels are the ideal stopping points for whatever waves that's under study. So if gold were to continue to pull back, a good stopping zone for green 4 here would be the highlighted zone at 24, call it 50 to 23.77. As we get off the weekly, get a little bit more detail here on the daily, and I'll pull one smaller degree of wave count in. You can see within green 3, which is the minor degree, we're going to break down into 5 smaller minute waves, which works well. And then are we seeing minute A, minute B, and then a decline in minute C? And as I said, is that going to be, I think, a leading indicator perhaps to where the stock market may be? So, I do have long individual equity positions that I'm continuing to hold. I'm using gold, a short gold position, as a bit of a hedge against those long stock positions. We'll see if this thing develops into something greater. So as we zoom in a little deeper here, I'll go down to a 6-hour chart here. Here is the internals of the ABC correction. So we can count a nice 5-wave motive impulsive move down in A. This is a little wonky here. I have it as kind of a weird flattened B. It's kind of weird. And then to move up in C, we went to the 786 retracement of red A and red B. This is the 618 projection of blue A and blue C, a nice stopping point here. Wondering if we're in a wave 3 of Red Sea decline that may bring us down into this green channel, which I don't think I mentioned on the higher time frame, but it's a typical 3v1 Elliott channel projected up from 2. So you have a really good support zone here. Let me see if I can pull this guy out. 24.49 to 23.77. Okay, so again, there's so much I want to get into. We'll save it for another video, but there's a pretty good rule of thumb I use, which the 786 retracement of any move is what I call the retracement of last resort. If 2587 breaks, which is 786 of this, that is going to be the square root of 0.618, which is the inverse of the golden ratio. Then you're going to move down into some lower extension levels, which will match up with the higher degree wave 4, 2450 to 2400. Okay, so I have, I'm still short gold. I have 2 contracts. I'm short 2 contracts of the 50 ounce. Average price right now is 26.61 on the short side. I was trading around this one. Originally shorted on December 12th at 27.09. Shorted another one, 26.70. Shorted another one at 26.53. I tried to put on a third contract. I put a really tight stop on him, 26.57. So it's FIFO, first in, first out. So, I have 27.09, and then I booked at 26.57. So whatever that is, call it 43 plus 9, $52 of profit there. And now I'm short these two, 26.70 and 26.53. Which gives us an average price at 26.61. I have a stop on one for now right here at 26.78-ish. I'm going to continue to let this guy go and see if we can get the punch through this 786 retracement at 25.87. And if we can get down and start moving in a third wave of C, I'm going to try to add that third contract back and expect the stock market to continue lower and see if that macro correlation is still in play. So hopefully it helps, guys. All the best. Happy holidays, and hopefully see you soon. Take care.